Well, hi and welcome. My name is Casey Boland. I'm a wealth advisor with HCM Wealth Advisors and CPAs, and I'm joined today by Doug Johnson, who is our senior investment strategist with HCM Wealth Advisors and CPAs. And Doug, we're going to talk all things election, the economy, the stock market. Give us an election recap. Who won what?
So we've got two out of the three main races decided. You had Donald Trump winning the presidential election. You had the Republicans taking control of the Senate, and then in the House. As I am looking at updated numbers right now, it looks like the Republicans have 214 seats, with the Dems at 203. 218 is needed for that majority. I think most projections have the Republicans taking control of the House as well, but I think until that is finalized, we're gonna let that go. But certainly a strong showing, I think, for the Republican Party.
Yeah, it certainly was. I'm going to be curious with that type of control, you would expect a lot of legislation can be done, but the thin level of majority, do you think they're going to be able to do anything they want, or do you think there's going to still be limitations?
Well, I think it'll certainly be easier when you have a straight majority like that, if that takes place. And I mean, there's a lot that's yet to be determined. And I think we'll talk a little bit about I guess the dangers of trying to make drastic portfolio allocations based on what may or may not happen from a legislative standpoint. But I think and you can add some too if you disagree. But I think the two main ones we're talking about here are going to be tariffs and taxes. Uh,
Yeah, it just seems like tariffs are going to be the big one. There's talk of imposing tariffs of 60% on China goods. That's an awfully high figure, maybe 10 to 20% on everything else that arrives in the US. You've got dial back regulations, clamp down on illegal immigration, cutting the corporate tax rate from 50 to 15% from 21% level. So there's a lot on the plate. It seems like it's a similar playbook as it was 8 years ago, but it was a much different time 8 years ago than where we were today.
yeah, and I think that there's obviously been some extremes that have been thrown out. Things like doing away with income taxes completely and replacing it with tariffs. I don't think that that's going to happen. But yes, it does take you back to the original, Trump presidency, where I definitely remember where there was a time where every day we were kind of scanning the headlines for updates on the U.S. China trade talks, and a lot of that had to do with tariffs. So, I think again, a lot has yet to be determined in terms of the tariff talks. I think there's certainly expectations that some of those are going to be levied at some point. But on the other side, I think there's probably a little bit more clarity on the fact that there won't be a proposal for taxes to increase, or even I guess the original Trump tax cuts that are, I believe, sunsetting 2025. Is that correct?
Yep.
That those will look to be renewed or adjusted, but I would say certainly not to the upside on both the individual and the corporate level.
So what was just your take, seeing what was like the initial reaction of the market, based on the election results?
It was very positive. And I mean, honestly, I don't think anything that happened was necessarily surprising other than maybe the magnitude of the move. From an S&P 500 perspective and from a small cap perspective, I believe that was the strongest post-election move in history,
Wow.
from a ranking perspective. So that's, that tells you the magnitude of what we saw. Small caps were up roughly, 5.5, close to 6%. The day after, you had some of the more value-oriented sectors that maybe have lagged kind of the more growthier names participating as well. I think you have financials up quite a bit. Energy did well, but There was certainly a big reaction in the equity market. Now, international did not perform well. They were the big losers there, and I think that kind of has to do that ties in a little bit with the tariff issue. I think it also ties in a little bit with one other part of the market that didn't do well was long-term treasuries, because you had rates kind of popping up, and I think the initial belief is that some of the Trump policies could reignite inflation. I think that's how you've seen why you've seen yields actually moving higher since the Fed did their original rate cut, which is somewhat counterintuitive. But I think if you think about it, it starts to make a little bit more sense. But that move in yield certainly affected bonds. The other area of the market that did not perform well was defenses. So things like consumer staples, utilities, those did not participate in the rally. So I think it was part relief rally that the election was decided. It wasn't necessarily a close race, so it wasn't going to drag on, and somewhat of a rotation as well to maybe a little bit of catch up for the assets that hadn't performed quite as well as the large cap growthier names.
Yeah, I think it's hard to take a day or a couple days and extrapolate that this is going to continue to play out. I mean, financials had a 10% plus pop, depending on the security you were looking at. And sure, there may be less regulation. Some of the thought is you may get more merger and acquisition type deals done. So but again, I think it's dangerous to take one day of movement in a stock or a different sector and area and then say this is how things are going to play out, because as you said, there's going to be some losers. And in the bond sector, I think it's going to take time for that to work out. On one hand, you could look and say, hey, maybe this is more high growth and that's the reason why bonds popped. But to your point, it could be, or is that going to be more concerned about inflation? So it's going to be interesting over time to see how the focus is, what the impact potentially of inflation, because one thing was very clear with this election, and that is the voters pretty much elected and said, we hate inflation. And it was not just in the US. If you look around the globe and you look at many of the other elections that occurred in other countries, you had a lot of other incumbents lost. And a lot of it was because of the concern about inflation and economic growth. And so, the US has been in a much stronger position from a global standpoint. So it is going to be, we'll see how things play out relative to US versus foreign stocks as well. So from the inflation standpoint, um, how should investors think about that? Is it a valid concern on the inflation part at this point?
So I'd say yes and no. I mean, we had peak inflation in this last cycle, close to 9%. We're back down in the 2.5%, 3% range. So we've made a lot of progress there. But yes, the next step is, how is that going to look going forward? And I think I was a little bit surprised at the reaction on yields, because they matched very closely to Trump's odds of winning on some of the betting sites. And I mean, I'll be completely honest. I don't think it matters who would have been elected. The government is really good at spending money. And I don't think there's any plans to stop doing that. So, whether that results in inflation or not, I think or reignition of inflation is yet to be seen. A little bit of inflation is not a bad thing. A
Yeah.
lot of inflation is a bad thing. And, I think the last cycle of inflation we saw, I think we have to remember, it was coming out of a very unique situation where you had a massive amount of both fiscal and monetary stimulus at the same time. Maybe the only time in history we've had money going directly to the consumer in terms of COVID stimulus. And then you also had a significant reduction in the supply chain based on everything shutting down. And that, those things don't just get solved with the flip of a switch. So, if that was the main driver of what we saw, then, we may be okay. And even if we do see a little bit of inflation, reigniting, I think the circumstances surrounding what we saw with rates going from 0 to 5% is not going to be the same as, you know, I don't see the Fed funds rate going from 5 to 10.
Yeah, and
We'll
it was
just do
good. It
that.
was good to see the Fed last week cut rates, and again, they seem to have indicated that inflation is on the right trajectory. May not be to the level yet that they want it, but it seems to be it's on the in the right trajectory. We are in a different landscape though. When Trump first came in office back in 17, inflation was considerably lower. You had consumer price index was around 2%. The federal deficit was about half of what it is now. But the other big thing too, it could be a challenge is stock market's been pretty good. Valuations though, PE when he first came in office, I mean, stocks are trading at about 16 and a half times earnings right before the 2016 election. And now we're somewhere between 22 and 23. What are your thoughts as it relates to the market and where valuations are?
Well, yeah, I mean, the interesting thing is if you take the index as a whole, um, I think it's a pretty objective statement to say that it's overvalued based on history. Um, but if you break it down into certain areas, I think the picture looks a little bit different. Some of these value sectors, specifically, in the small cap area that we just talked about, I think have valuations that are very much in line historically. And then if you look at them on a relative standpoint versus their US counterparts, then you're getting into some, historical ranges in terms of being undervalued versus what US large cap has been doing. And the challenge in all this is always timing, because you've had all these factors lining up for those sectors. I mean, you can even throw international in there if you wanted, but it hasn't mattered because US large cap growth has been such a dominant force in terms of driving return. So, going forward, I would be very interested to see some of these other areas start to reassert themselves. The fundamental backdrop is there. We just need the price to cooperate going forward. And I think the other thing too to remember is that we're about to enter, we're kind of already entered historically the strongest seasonal period for the market. This time from mid-November to the end of the year is when a lot of returns take place in the market. Then you have it coming off an election, and then you also have what I would say would be muted selling pressure at the end of the year based on trying to realize taxable gains, because again, I don't think taxes are going to go higher. So there may be less pressure on investors to try to realize those gains at lower rates. And then also, sometimes you see tax loss harvesting at the end of the year. Frankly, there's just not a lot of losses to harvest. It's been a pretty solid environment for almost all equity, or almost all asset classes over the past 2 years. So a lot of those losses I think have already been taken.
So based upon what you just outlined, thinking about the election, you made a great point on valuations in that that's the overall market. There's pockets, there's areas that have reasonable valuations, and we're in a good time period. So based upon all those pieces, what are your thoughts about portfolio positioning?
Yeah. So, two things I'll say there. One is if you've made major allocation adjustments based on the election, it's probably time to revisit those. Whether that was going, 50% cash or taking significant cash positions, investing in certain sectors that you thought would do better based on who won. Regardless, I would certainly revisit those and see if they still make sense. That's my first thing. Secondly is we still think that there's a lot of things to be played out here. We're certainly still what I would say bullish on the market. As our positioning in tactical portfolios, we remain overweight equities. I think at the margin, we're looking at areas that we may be able to adjust based on some of the price action that we've seen post-election. But we're certainly not going to go in and make any major changes based on things that we think will happen. and I want to reiterate that because I think we spend a lot of time making predictions on things, but the reality is we make a lot of our decisions based on data, and using that in conjunction with maybe some forecasting. But the data needs to ultimately line up with any and all decisions that we would make. But from an allocation standpoint, we're certainly looking at some areas where we think we could see some good runway going forward, and then also some areas that we think might see some headwinds going forward. But at the end of the day, there's nothing drastic on the horizon from our perspective.
Yeah, I mean, it's with a strong tariff policy, foreign stocks may come under pressure. We'll have to see how it plays out based upon the initial knee-jerk reaction. Certainly, small caps may be attractive. One could make the argument when you look at if from a tariff standpoint, you have companies that are more dependent on domestic and less dependent on being able to import. So that may be an advantage for them. Valuations are very attractive. So I think to your point, there's a lot of areas that we're watching. We'll have to evaluate and see how these things play out in time. But you can't necessarily take the knee-jerk move oftentimes of what happens in a couple days in the market and extrapolate that and say, hey, this is how things are going to play out. Part of it's going to be from a policy standpoint. We know a lot of what's on Trump's mind, but the order or the magnitude could be very important on what gets implemented and the impact potentially to the economy and the market.
Yeah. The easiest way that I think I can phrase it is so far so good.
Yeah, which was great. It was a great initial reaction last week. And as you mentioned, the environment seems to be right for year end for a rally. So hopefully that will continue to hold place. Clients, prospects, if you want to reach out, you have an interest in HCM, don't hesitate to reach out. We're glad to answer questions you have. Clients, if you want to better understand how this may mean to position with your portfolio, don't hesitate to reach out to your advisor or reach out to Doug directly. So we appreciate the time that you spent with us on this stock market election. I think everybody had the relief that the election came and went very quickly. And I think certainly that was a big contributor to the move in the market. So we'll take it and continue to wish for the best, and but readjust portfolios as we see information as that comes. Doug, any last final thoughts?
Oh, I mean, I think we covered everything. I'd reiterate if from a client or prospect perspective, if you've got any questions or you want more detail on anything we discussed, feel free to reach out to us. We're happy to hop on a call and go over that with you.
Great. Thank you so much for joining us today.